What if I told you that the most powerful financial institutions on the planet, the very entities that control the global money supply, have been quietly doing something they haven't done at this scale in nearly 6 decades? Not investing in stocks, not buying bonds, not pouring money into real estate. They've been stockpiling gold. Physical, tangible, hold it in your hands gold. And not in small amounts. We're talking about a buying frenzy so intense that analysts are calling it a 58-year record. The question you need to ask yourself right now is this: if the people who print the money don't trust the money, why should you? Let's talk about what's actually happening, because most of what you're hearing in the mainstream financial press glosses right over the magnitude of this moment. Gold has surged well past the $4,000 per ounce mark, and even after recent pullbacks, it remains at historically elevated levels. Silver has roughly doubled over the past year, and yet central banks around the world are still buying. They are buying into this rally. They are buying at prices that would have seemed unthinkable just a few years ago. That tells you something. It tells you that the people with the most sophisticated financial intelligence on Earth believe that even at these levels, gold is not expensive. It's going higher, and they want to own as much of it as possible before the rest of the world figures that out. Now, before I get too deep into this, I want to quickly mention, if you check the description below, I put together a free guide that covers the saving secrets that thousands of American retirees are already using to protect their hard-earned wealth from exactly the kind of chaos we're about to discuss. It takes about 5 minutes to go through, and it could be genuinely valuable for your financial future. Link is in the description. Let's continue. To truly understand what's happening today, you have to go back to a decision made in 1971. That's when President Nixon closed what was known as the gold window. Prior to that moment, every dollar in circulation was theoretically backed by physical gold sitting in U.S. vaults. Foreign governments could show up and exchange their dollar reserves for actual gold at a fixed rate. That was the deal. That was the foundation of the post-World War II financial system, what economists call the Bretton Woods Agreement. And then, almost overnight, Nixon ended it. The dollar became what's called a fiat currency, backed by nothing except trust in the United States government and its ability to manage its finances responsibly. At the time, most economists said this was fine. Modern monetary theory would take over. The dollar was king. Gold was a relic of a barbarous era, as the famous economist John Maynard Keynes once called it. For decades, central banks actually sold gold. They viewed it as a liability, something sitting in a vault collecting dust, when it could be deployed elsewhere. The Bank of England infamously sold half its gold reserves in the late 1990s, near the very bottom of the gold market. Canada sold virtually all of its gold. Switzerland sold hundreds of tons. The conventional wisdom was that gold had no place in a modern reserve system. So what changed? Everything. The first major wake-up call came in 2008, when the financial system nearly collapsed under the weight of mortgage-backed securities, credit default swaps, and the reckless leverage that had been allowed to build for decades. Central banks around the world watched in horror as the entire edifice nearly came down. Governments responded by doing something radical. They printed money. Trillions of dollars, euros, pounds, and yen flooded into the financial system to prevent total collapse. And it worked. Sort of. The crisis was averted, but the cure created its own disease, a massive expansion of the money supply that never truly went away. The balance sheet of the Federal Reserve went from under $1 trillion before the crisis to multiple trillions after it, and it never went back down to normal. Central bank gold buying started picking up after 2010. Nations that had spent decades watching the West dominate the global financial system through dollar hegemony started to get nervous. They started asking a question that was once considered almost treasonous to speak aloud in global financial circles. What happens if the dollar stops being reliable? What happens if the United States uses its control of the global reserve currency as a geopolitical weapon? That question got answered definitively in early 2022. When Russia invaded Ukraine, Western nations responded by freezing roughly $300 billion in Russian central bank foreign currency reserves. Those dollars, euros, and pounds that Russia had been accumulating as a financial cushion were simply locked, inaccessible, gone. Not stolen, technically, but functionally unavailable. The message that sent to every non-Western nation on Earth was crystal clear. If you keep your reserves in dollars or euros, you are one political dispute away from having them taken away from you. Gold stored in your own vaults, that cannot be frozen. It cannot be sanctioned. It cannot be seized by a foreign power through a banking system. It is yours. Within months of that announcement, central bank gold purchases exploded. In 2022, central banks around the world collectively purchased over 1,100 tons of gold in a single year, the largest annual total since modern record keeping began. The year after that was nearly as large. And then in 2025, analysts confirmed that central banks had reached a 50-year accumulation record. Think about that for a moment. You have to go back to the late 1960s, right before Nixon closed the gold window, to find a period of comparable central bank hunger for physical gold. That's not a coincidence. That's a signal. Let's talk about who's actually doing this buying, because it's not one country. This is a global movement. Poland's national bank became one of the most aggressive buyers in the world, acquiring over 100 tons in a single year. That's a nation right on the front lines of European geopolitical tension, right next to the Ukrainian border, that decided the smartest thing it could do for its financial security was to dramatically increase its physical gold holdings. Poland's governor has stated publicly that gold is the ultimate safe haven asset, one that carries no counterparty risk, no credit risk, and no political risk. Kazakhstan has been buying consistently. Brazil has been buying. Nations across Central Asia and Southeast Asia have been piling in. The Bank of Korea has announced plans to include gold in its reserves for the first time in years. Bank Negara Malaysia has entered the market. And then there's China. Now, China reports its official gold reserves, currently somewhere around 2,300 tons. But analysts who study this market closely believe the actual number is substantially higher. China has historically made large purchases and then disclosed them years later in one announcement. They are not incentivized to broadcast exactly how much gold they're buying, because doing so would push prices even higher. So the official figure is almost certainly an understatement. What we do know is that China has been buying consistently, month after month, and their stated goal of reducing dependence on the dollar as a reserve currency requires them to hold something else of value. Gold is the obvious answer. It's why they've been building infrastructure for physical gold settlement, developing gold trading markets in Shanghai, and positioning themselves to play a much larger role in the global gold trade. Russia's situation is more nuanced. They've held massive gold reserves for years, over 2,300 tons, which is what allowed them to weather the sanctions regime better than anyone expected. When your reserves are in physical gold sitting inside your own borders, a foreign government can do nothing to touch them. Russia has demonstrated to every other nation watching that gold is geopolitical armor. Even as Russia has sold some gold in recent months to fund its ongoing fiscal needs, the lesson they taught the rest of the world by surviving those sanctions is clear. Physical gold in your own vault is the ultimate insurance policy against geopolitical weaponization of the financial system. Now, I want to explain something that most mainstream financial coverage completely ignores, because without understanding this piece, you can't fully appreciate the magnitude of what's happening. The gold market that you see quoted on financial websites, the paper gold market, is not the same as the physical gold market. When you see a gold price on CNBC or Bloomberg, you're looking at the price of a futures contract traded on exchanges like COMEX. These contracts represent promises to deliver gold. But here's the thing. The overwhelming majority of these contracts are never settled with actual physical gold. They're settled with cash. Traders buy and sell these contracts purely as a financial instrument, without ever touching a single ounce of real metal. Estimates suggest that for every ounce of physical gold that exists, somewhere between 50 and 100 paper claims on that gold are trading in the futures markets. For years, this system worked because most people holding those paper claims never actually asked for delivery. But something has shifted. Increasingly, entities are demanding physical delivery. COMEX inventories have been under significant strain. Physical gold has been flowing out of London's LBMA vaults to places like New York and elsewhere as institutional buyers scramble to secure actual metal. Analysts are warning that if this trend continues, inventories could face real depletion pressure. And when the day comes, if it comes, when a major futures exchange cannot deliver physical gold to match its paper promises, the gold price discovery mechanism as we know it could shatter. The paper price and the physical price could diverge dramatically, with physical metal commanding enormous premiums over the futures price. That's not a fringe theory. That's a structural risk that serious market analysts are actively discussing right now. JP Morgan, not exactly a gold bug newsletter, has projected gold prices to reach well over $5,000 per ounce as this cycle progresses. Goldman Sachs has maintained bullish forecasts. Major institutions that once scoffed at gold are now treating it as a serious strategic asset class. That's a remarkable shift from even a decade ago. And while we're talking about institutional behavior, let's talk about ETFs. Gold-backed exchange-traded funds have seen massive inflows. When institutional investors, pension funds, sovereign wealth funds, endowments, can't hold physical gold directly, they use ETFs as a proxy. And those ETFs are required to buy actual physical gold to back their shares. So every dollar flowing into gold ETFs translates into real buying pressure in the physical market. Combined with central bank demand, this creates a structural floor under prices that didn't exist in previous gold cycles. Now, let me walk you through a historical parallel that I think is incredibly instructive, because markets have a way of rhyming, even when the details differ. Go back to the late 1970s. The United States was dealing with a combination of factors that feels eerily familiar today. Persistent inflation that had been fueled by government spending, a weakening confidence in dollar-denominated assets, rising geopolitical tensions, an energy crisis, and a sense that the post-war financial order was fracturing. Sound familiar? Gold went from roughly $35 an ounce when Nixon closed the gold window in 1971 to nearly $900 an ounce by January 1980. That's a move of more than 25 times in less than a decade. The people who recognized what was happening early and positioned themselves in gold were protected. The people who stayed in traditional paper assets watched their purchasing power erode in real time. Now, I'm not saying the move today will be identical. Every cycle is different, but the structural drivers are remarkably similar, and in some ways, significantly more extreme. The US national debt has grown to a level that previous generations would have considered completely inconceivable. The unfunded liabilities in Social Security, Medicare, and pension obligations represent obligations that cannot be met without either significant inflation, significant monetization, or significant default. None of those options are pleasant for holders of dollar-denominated assets. All of them, historically, have been friendly environments for gold. Here's something else the 2011 silver story teaches us. Silver went on an extraordinary run during that period, driven by the same monetary forces driving gold, but amplified by silver's dual nature as both a monetary metal and an industrial one. Silver has critical applications in solar panels, electric vehicles, semiconductors, and medical devices. Industrial demand is not going away. In fact, it's accelerating with the energy transition. And yet, silver supply is constrained. There are very few pure silver mines. The majority of silver production is a byproduct of mining other metals. When industrial demand surges and monetary demand surges simultaneously, silver can move in ways that look almost violent to the upside. We're seeing silver's year-over-year price appreciation already running at extraordinarily elevated levels compared to most other asset classes. The gold-to-silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold, remains historically elevated, which historically has been a leading indicator of silver outperformance ahead. At this point, I want to talk directly to you if you're approaching retirement or already in retirement, because this is where the conversation becomes intensely personal. You've spent decades building your wealth. You've made sacrifices. You've saved consistently, contributed to your 401k or IRA, navigated market downturns, and arrived at this chapter of your life with real assets behind you. The question now isn't how to get rich. The question is how to protect what you've built. The nightmare scenario for any retiree isn't losing a little money in a stock market correction. The real nightmare is a sustained period of inflation that quietly erodes the purchasing power of your savings, while your account balance stays flat or even rises nominally. Your account says you have a certain number of dollars, but those dollars buy fewer groceries, fewer medical services, fewer of everything you need. That's the silent robbery that inflation represents. And with the kind of monetary expansion we've seen in recent years, the risk of that scenario is very real. If that kind of wealth protection is something you're actively thinking about, I'd encourage you to look at the free guide in the description below. It covers some of the specific strategies that thousands of American retirees are using right now to hedge their hard-earned savings from exactly these risks. It's a short read, and it's genuinely informative. And since we're on the topic, For anyone who wants to go a step further and actually add physical gold to a tax-advantaged retirement account, a gold IRA is worth understanding. A properly structured gold IRA lets you hold actual physical precious metals within the retirement account wrapper, with the same tax advantages you already have in your 401k or traditional IRA, but with the protective characteristics of real gold rather than paper assets. If you're sitting on a substantial retirement account and you've been wondering whether gold belongs in your financial picture, that's worth exploring. The link in the description has more details on how the mechanics work. Let's talk about the geopolitical picture for a moment, because it is impossible to separate the gold story from the geopolitical story right now. The de-dollarization trend, which once sounded like the fever dream of conspiracy theorists, is now being covered seriously by the Wall Street Journal, the Financial Times, and The Economist. BRICS nations have been actively developing alternative payment systems and exploring commodity-backed trade settlement mechanisms. The percentage of global trade being conducted in dollars has been declining. Central banks that once held the majority of their reserves in U.S. treasuries have been diversifying. Saudi Arabia has been in discussions about accepting non-dollar currencies for oil transactions. The petrodollar system, the arrangement that has underpinned dollar dominance since the 1970s, is under its most serious challenge since it was established. Now, the dollar is not going to disappear tomorrow. Let's be clear about that. The dollar still represents the world's primary reserve currency and will for the foreseeable future. But reserve currency status has historically been less permanent than people assume. The British pound was once the world's dominant reserve currency. Before that, it was the Spanish real. Before that, it was the Dutch guilder. Every reserve currency in history has eventually given way to the next one. The question is not whether that transition happens eventually. History says it will. The question is whether you're positioned to protect your wealth through the disruption that comes with that transition. The smart money, and we've spent this entire video documenting exactly who the smart money is right now, has made its choice. Central banks accumulating at a 58-year record. Institutional investors piling in through ETFs. New sovereign buyers entering the market. Physical demand straining paper markets. JP Morgan forecasting continued price appreciation. Every major signal in this market is pointing in the same direction. And here's the thing that I keep coming back to when I look at this data. Central banks are not emotional buyers. They don't get caught up in hype. They don't chase trends. They move slowly, deliberately, and strategically. They have rooms full of PhD economists and analysts who stress test every major allocation decision. When those institutions, the most cold-blooded, analytically rigorous entities in the financial world, are buying gold at a pace not seen in nearly 6 decades, that is not a coincidence. That is not noise. That is signal. Powerful, clear, unmistakable signal that something fundamental has shifted in the global monetary landscape. The small investor, the retiree, the person trying to figure out how to protect what they've earned, they rarely move before the institutions. Historically, they move after. And by the time the mainstream narrative catches up to what the central banks are already doing, the easiest gains have often already been made. The window to position yourself ahead of that shift is not infinite. So let me leave you with this. The next time someone tells you that gold is just a shiny rock with no utility, ask them why Poland just bought over 100 tons of it. Ask them why China and Russia have been quietly building their reserves for decades. Ask them why the World Gold Council is reporting 58-year records in central bank accumulation. Ask them why JP Morgan has been raising its price targets. Ask them why physical gold is being pulled out of London vaults faster than it can be replaced. The shiny rock argument is a comfortable fairy tale for people who haven't looked at the data. If you've made it to the end of this video, I want to make sure you know about something exclusive. For American retirees who have watched all the way through, and specifically for those who have at least $100,000 in any retirement account, when you check out the guide in the description, you'll have the opportunity to mention that you watched this video until the end. If you do that, you'll qualify for a complimentary one-on-one educational web conference. No obligation, no pressure. Just a genuine conversation with someone who can walk you through exactly how these strategies apply to your specific situation. That offer is specifically for American retirees who qualify. It won't be available forever, but for those who take action, it can be genuinely clarifying. The central banks know what's coming. The question is whether you do.